What up, Hyperchange? Welcome to another episode. Today we're going to be talking about Goldman Sachs' recent downgrade of Tesla stock. Now, I personally put absolutely zero weight into anything that Goldman Sachs says, especially coming from their equity research division, but the market seems to be kind of freaking out about this, so I thought we'd talk about it. Anyway, the headline is Goldman Sachs cuts Tesla price target, predicts Model 3 disappointments, and capital raise. This came out yesterday, Tuesday, April 10th. Goldman Sachs reiterated sell rating, cutting the price target from 205 to 195, implying 32% downside for the stock. The biggest reason beyond the capital raise, which first I briefly want to point out that Tesla's business model right now, while they're in startup mode, while they need money to expand their operations, is to consistently dilute shareholders. I personally do not have a problem with this. I think this is just what growth companies do. This is like startups raising venture funding. They need money to build all these factories, to build a bunch of products, then they'll make money later. That's the mode that Tesla's in. That's why you always hear about them diluting, raising bonds, selling stock, because that is part of their business model while they are in growth mode. I am okay with that because the company's growth rate is astronomical. Since their IPO, they've only diluted their share count by less than 100%, but they have grown revenue over 10,000% in the same period. The analysts love to point out how they need to raise capital. That's always part of their business model. I think it's actually accretive when they raise capital because they spend the money so efficiently, plow it right back into growth. That's what they need to be doing at this stage in their business. Thing number two, and this is just what I'm seeing from the CNBC article, mind you, the actual report, I don't even have access to. It only goes out to Goldman clients. You have to be special or fancy to get access to it. I don't. So anyway, the other thing he says, which I thought was really interesting, is we believe the sustainable production rate for the second quarter of 2018 is most likely below the 2,000 vehicle mark the company achieved in the final week of the first quarter. We see the company likely sustaining Model 3 production around the 1,400 per week mark. So basically what the analyst is saying is Tesla just reported Model 3 production had passed 2,000 per week. They're going to keep ramping. He says, nope, that was just a blip. They just rushed it at the end of the quarter. Production throughout Q2 is going to more average around 1,400 vehicles per week. I just think that is going to be absurdly wrong. You know, Tesla, yes, they do have a habit for extrapolating their last week of their quarter and saying we're going to do that when they don't. But this time it actually appears like production is ramping well beyond 2,000 units per week. Don't just take it from me, take it from Bloomberg's VIN tracker, which we've been following closely here on the channel. Now, as of today, actually indicates Model 3 production is well over 2,000 per week and should be scaling to 3,000 per week shortly. This is also in line with all the VIN data we've been seeing, where just last week, Tesla registered about 7,000 new Model 3 VINs, indicating that production is ramping significantly. All the evidence that we're seeing in the real world shows that Tesla is producing over 2,000 Model 3s per week and will continue to scale that rapidly throughout the quarter, yet Goldman is saying they think Model 3 production is going to be stuck at 1,400 per week for the quarter. I'm taking the other side of that trade. I think they are going to be way off. There's just no validation to his report. I don't know what his reasoning is because I can't read his actual report. David Tamberrino, let's pull him up on TipRanks, which is a cool little service that rates bloggers and analysts on how their picks perform. As you can see, he even has less than a half-star rating out of 5 stars. He is ranked number 4,502 out of 4,800 analysts that TipRanks track. He is almost the worst performing analyst that you could possibly have on TipRanks. Of course, if you compare this to my personal TipRanks, you can see quite a stark difference in the I don't know. Who cares? Let's just, I don't know if TipRanks is actually legit or not, but I'm definitely a fan of my rating on their site. Anyway, the other thing that I thought was fascinating is there is a very kind of nuanced thing within investment banks that happened with regulation a few years ago, which is that they have to separate their equity research division, the research analysts like David Tamberrino who issue their report, and their investment banking or investing division that's actually investing in companies. There's something called the Chinese wall. This is I'm not making it up. It's sort of an official finance term that indicates that these two divisions of the bank cannot talk to each other because there'd be a conflict of interest. And what's so fascinating is while David Tamberrino, the equity research analyst on this side, is putting out reports saying Tesla is only worth $195 per share and it's a sell and they're not going to hit any of their targets, Goldman Sachs, the investment bank, actually owns over $330 million worth of Tesla stock, is one of the largest institutional investors in the company, and in fact, according to the last quarterly data we have, Q4 2017, significantly increased their position. So Goldman Sachs, as of the end of Q4 2017, owns almost 1.1 million shares of Tesla stock. That was up 78% from Q3 2017. They added 476,000 shares in the quarter. Their total dollar value of their position is over $331 million. So just to clarify for you guys, the analyst for Goldman Sachs, who's just, spouting all these things about Model 3 production sucking and how Tesla's a sell, comes out with a $195 price target today. Goldman Sachs, the investment firm, has been buying Tesla stock and owns a $330 million position. If we're going with the put your money where your mouth is, let's see what they're actually doing with their capital. Goldman Sachs appears to be a pretty strong believer in Tesla. They're literally investing hundreds of millions of dollars with the company. And what's so fascinating is, remember I said they added 476,000 shares in Q4 2017. Well, what's so interesting is if you take a look at that, Q4 2017, Tesla stock was around $300 per share. And guess what? This was at the time when their analyst from their equity research division was rating the company at a $210 price target. In fact, downgraded the company from $210 price target to $205, while the investment bank is literally simultaneously buying the stock at $300. How does your equity research division, this fancy analyst who apparently knows what he's doing, he's working for Goldman, saying this stock, Tesla, is worth 200, it's a sell, it's going down, they have all these issues, but your asset management division or your investment bank that's actually managing the money is buying the stock at 300. It's not just Goldman that does this. This is probably every firm on Wall Street has a very similar, dichotomy. Their analysts are saying one thing, the bank's actually doing the other. This is totally mainstream. One of the reasons why I, seem to always have a gear to grind with Wall Street is because of this kind of thing they do. I just think it's BS that the headlines are all Goldman sells, Goldman says Tesla's a sell, but really they own $330 million worth of stock. So that is what it is. And just beyond that, his entire rationale that, Model 3 production is only going to be 1,400 per week for all of Q2. I'm sorry, that's going to be so off. I have an episode coming out where I'm going to predict what Tesla's production for the quarter will be. Guarantee it will be drastically higher than that. On top of that, him just consistently saying that the company is going to need to raise capital and that's an issue is just a fundamental misunderstanding he has of the Tesla business model and where they're at in the business cycle, and needing to raise capital has been a part of their plan since day one. And the investors are okay with that and still believe the company has upside, and apparently so do your counterparts at Goldman because they own shares as well. So that wraps up this episode. This is Hyperchange. Would love to know what you guys think about this in the comments below. If you like this episode, you want to support Hyperchange, then definitely check out our Patreon page. You get access to an exclusive newsletter. You also get to see Hyperchange, the company's quarterly financials, so you can follow our progress. Anyway, I'll see you guys next time. Peace.